Welcome to The Explainer. Today, we're cutting through the market hype to find what actually matters for your long-term wealth. Look, our whole mission here is to build a financially aware, empowered community with really practical, easy-to-grasp knowledge. Just a quick heads up before we jump in. This explainer is strictly for educational purposes, okay? It's not buy or sell advice. Always consult your financial advisor because, as we all know, mutual funds are subject to market risks.
All right, here's our roadmap for today. We're looking at the Viyash turnaround, facing some mutual fund realities, figuring out how to escape debt traps, and lastly, bursting some tech stock valuations. Let's dive right in.
Section 1. Viyash Scientific. Finding the signal. So, could Viyash Scientific be the next Laurus lab? You might actually remember them by their old name, Sequence Scientific. Man, that stock price crashed all the way down to 6 rupees. It totally exhausted retail investors and, honestly, they mostly just packed up and left. But here's the thing, that removed a ton of market noise. The real turning point? Becoming Viyash Scientific. They brought in Dr. Hari Babu. He used to be a top guy at Mylan Labs, merged with Viyash Life Sciences and completely turned that messy past around. We're talking a super steady 20% EBITDA margin over the last 3 quarters.
And when you look at their revenue foundation today, it's pretty fascinating. 45% is coming from animal healthcare, 43% from API and CDMO, and 12% from human formulations. The big catalyst here, the booming global pet care market. I mean, pet adoption is soaring globally, right? So to capitalize on that, they just bought Italy's Biopharma Life, instantly unlocking that massive European market for themselves.
Now check out this number. Management has put out this massive guidance for 2032. They want to hit $1 billion in revenue. That's roughly 9,500 crores. It would basically triple where they are standing right now. If they can actually pull off this aggressive target and keep their margins up, well, with the retail noise gone, this is a serious opportunity we need to be paying attention to.
Moving on to Section 2, Mutual Funds. Patience over panic.
Okay, a lot of people are asking, should you immediately exit the Parag Parikh Flexi Cap Fund? Investors are seriously rushing for the exits because of some recent underperformance. But the data tells a completely different story. Look, this is a classic bear market fund. During the massive bull markets of 2016 and 2022, yeah, it ranked right at the bottom in the 3rd and 4th quartiles. But remember what happened when the market crashed between 2018 and 2020? It rocketed straight to quartile 1. They might lag when the market is flying, but they aggressively protect your wealth when things crash. You gotta have patience here.
Speaking of chasing returns, you've probably seen social media hyping up an alternative product to mutual funds lately, these specialized investment funds, or SIFs. Influencers are pitching them as these magical, aggressive wealth-building tools. But let's get real for a second. These are incredibly complex financial products that mostly use derivatives for hedging. They are absolutely not magic bullets for aggressive returns.
So before you even think about touching an SF, you need to hear these rules. First off, ignore the social media FOMO. Just tune it out. Second, you have to wait 2 to 3 years for the actual performance data. These things are brand new in India, which means our fund managers literally don't have long-term track records with them yet. And here's the kicker. A viewer with a 6 lakh portfolio asked us if they should dump it all into an SF. Absolutely, unequivocally, no. To safely put just 10% into an SF, you need a portfolio of like 50 lakhs to a crore. Risking a small portfolio on an untested hedging tool, that is just dangerous noise.
All right, Section 3, Personal Finance, Escaping Debt Traps.
We got this incredibly important question from a 35-year-old viewer. So, he just landed a solid railway job making 48,000 rupees a month. Awesome, right? But he's drowning in 2.5 lakhs of credit card debt, plus a 3 lakh outside loan that's charging him a mind-blowing 2% monthly interest. And his question was, should he start investing for his daughter or buy a car for his 50-kilometer commute? Look, it's so easy to daydream about buying a car or starting investments, but this guy's financial house is literally on fire right now.
So here is the emergency rescue plan he absolutely has to follow. Step 1. Since he's a government employee, he needs to leverage that and get a low-interest personal loan. Step 2. Take that loan and instantly wipe out that toxic 2% monthly loan and those credit cards. Step 3. Completely pause any ideas of buying a car or a bike. Instead, he needs to move closer to work. Driving 50 kilometers every single day is just going to destroy his health and his wallet anyway. And finally, Step 4. Build a 1 lakh fixed deposit emergency fund. Only after doing all of that should he even look at a mutual fund or a Sukanya Samriddhi Yojana for his daughter. Kill the debt first, period.
And man, this brings us to a really heartbreaking lesson about getting deceived. We had a former IT employee reach out. He guaranteed a 5 lakh loan for a friend. Well, tragically, he lost his IT job. And guess what? The friend just stopped paying the interest. To protect his family's honor, this guy had to drive for Rapid on Zomato just to cover someone else's debt, completely unsupported while his wife was pregnant. His message to us is a harsh reality check. When it comes to money, trust absolutely no one and never ever guarantee a loan you can't afford to pay off yourself.
Let's move to Section 4, Tech Stocks and Valuations. Bursting the Hype.
All right, let's talk about Nazara Technologies, famously known right now as the stock Nikhil Kamath's associates invested in. Now, there are some real fundamental growth drivers here. Their narrative games, like the one based on Love Island, are crushing it, bringing in 27% of their total revenue. They're also expanding offline with Smash 2.0 and Funky Monkey. Plus, their new Nazara OS is apparently cutting game development time from 18 months all the way down to just 2 months. That's huge.
But, and this is a massive but, you have to be so careful here. If you just pull up a stock screener platform, it'll tell you Nazara's PE ratio is a super cheap 11x. Looks like a steal, right? Don't blindly trust these platforms. If you sit down and actually do the math based on their core earnings, the reality check hits hard. Nazara is actually trading at an insanely expensive multiple of around 118 to 119 times. The underlying business is doing some cool things, sure, but the stock price is just completely detached from reality.
Honestly, if crunching those real PE numbers is giving you a headache, it's time for a mental break. For our Sunday Funday suggestion this week, go check out the movie Boot Bangla. Look, go in with zero expectations and you might actually find the first half comedy pretty funny. Sometimes you just need to turn your brain off for a bit, right?
Okay, getting back to business and valuations, let's look at Rashi Peripherals. Everyone's asking, is it a good time to buy this AI-linked stock? I mean, they distribute from massive players like Dell, HP, and NVIDIA, and the stock is rallying like crazy purely on AI hype and NVIDIA chip shortages. But what's the reality check here? At its core, this is a low-margin distribution business. As soon as the supply chain normalizes, those temporary extra margins will vanish. So paying an 18x PE for a pure distributor? That is just incredibly expensive.
Finally, let's ask, what is the real opportunity in Cupid right now? Well, speaking of absolutely absurd valuations, this stock is trading at a mind-boggling 74 times price to sales. Not earnings, sales. Unless they've secretly invented some magic patented technology overnight, there is literally zero fundamental logic backing this up. And yet, retail shareholders have just doubled to over 2 lakhs. Guys, when retail investors pile in blindly like this, completely ignoring the fundamentals, that's not an opportunity. That is a massive blaring alarm bell.
And honestly, that perfectly sums up the core theme of this whole explainer. As you navigate your wealth creation journey this week, I want you to look closely at your portfolio and ask yourself one really vital question. Are you investing based on true business value, or are you just blindly chasing the daily noise? Leave the hype behind, focus on the fundamentals, clear out that high-interest debt, and just have the patience to let your real wealth compound. Thank you so much for joining me on this explainer. Stay focused